You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koós, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
All right, Happy New Year, everybody, and welcome to the Cash Podcast, our first investment education piece of the new year, I'll say. Today we're going to be talking about, or I'm going to be showing you some of the best ways, or one of the best ways that I've personally used to build a winning investment management strategy, one that you could use yourself as well, or at the very least, hopefully you'll find this educational. But first, before we get started, as always, a few housekeeping items. If this is your first time listening or watching, thank you so much for joining us. The Cash Podcast is produced weekly, and as stated in the intro, CASH stands for creating affluence, success, and happiness, and that's our goal. Our mission is on every episode for you to find yourself walking away a little bit more educated than you were when you showed up. So please feel free to subscribe both on iTunes and YouTube. If you want to check us out on Twitter, you can find me at Adam Koós, as well as on Instagram at Financial Surgeon. And last but not least, all links, charts, images, or visual aids that we'll have today will be available on the web for those of you that are listening on iTunes and want to check out the visuals later. Just to be clear, we're not going to have really heavy visuals. We'll have a few things that we'll show, but nothing that's going to make this anything out of the ordinary. We're not going to have any heavy charts to go through today. So without further ado, let's go ahead and get started today. Again, like I said, we're going to be talking about building a winning investment strategy, and the subtitle here is, staying invested in the playoff teams and avoiding the rest. And as you know, for those of you that have listened before, who have watched this before, I always love to start with a quote. I love quotes. I'm a big quote person. And this one's Walter Deemer, and he said, no stock in an uptrend has ever gone bankrupt. And I think the same can be said, because I'm going to use some sports analogies. I apologize for those of you who aren't big sports fans, but I always have several sports analogies because they always seem to work when it comes to investing. But Walter Deemer said, no stock in an uptrend has ever gone bankrupt. I think similarly speaking, no team with a winning record rarely makes the playoffs. And you could attribute that to NFL playoffs, which is what we're seeing right now on TV. We can look at March Madness. We can look at the Olympics. We can look at the CrossFit Games, volleyball, NHL hockey, Major League Baseball, and across all sporting events, those teams with the best records, those teams that are doing well, tend to make the playoffs. They don't always win the national championship. They don't always win the Super Bowl. But I think the goal here isn't to pick the best winner, because that's pretty tough to do. I think the goal is to stay invested in the best teams as much as possible. I say all the time, but we're going to talk about that. So moving on, let's talk about how to do this. So it's I'm of course, for those of you who know me, I grew up in the Cleveland area. I'm a huge Browns fan. When I was growing up, I used to build a shrine around the TV. I used to get so upset because obviously the Browns weren't so great for the past few decades. My parents bought me this referee that had limbs and a head that was velcroed on, so when I got upset at the TV, I could rip a limb off and throw it at the TV. I don't know, maybe that's a little bit morbid, but it's I've always been a big, passionate Browns fan, and even through all the horrible seasons and through all the turbulence and tough times that we've had, for any Clevelander or anybody who's a Browns fan, this is a pretty amazing year. This is the first time that the Cleveland Browns have made the playoffs in 17 years. And obviously before that, between 1996 and 1999, they didn't even have a team. So there was a time period where they couldn't compete, obviously, because they didn't exist when Art Modell took the team in the middle of the night to Baltimore. And then Baltimore won the Super Bowl a couple years later. So I always say the Baltimore Browns, I guess, if you will. But not only have the Browns been to the playoffs now for the first time in 17 years, but this is the first time they've won a playoff game since I got my driver's license. Now, I'd like to think I'm young, but I don't feel that much, that young anymore these days, and that was a pretty long time ago. And then to make this even more crazy, or crazier, if I'm using correct grammar here, I guess I'm a numbers guy, but I have to use good grammar. This is the first time the Browns have beat the Steelers in a playoff game since my parents were high school sweethearts at 17 years of age in Lorain, Ohio, attending Lorain High School. So it's been a really, really long time since some of these things have happened. And I am going to draw an analogy here when it comes to investing, which is, what if all the teams in the NFL, just because that's what we're talking about is the NFL playoffs here, and the Browns in this case, but what if all investments that we could buy were football teams in the NFL? Wouldn't have wanted to have your money, your hard-earned savings, your retirement money invested in the Cleveland Browns this last couple decades? And I think the answer would probably be no. In fact, I wouldn't throw money, as much as I love my Cleveland Browns, I've been saying almost my entire career, using this analogy, that I wouldn't throw $1 at them, because they just haven't seemed to figure out a way to win games, let alone make the playoffs. So anyway, moving on, the statistics look like this. There are 32 teams in the NFL. 14 of those teams make the playoffs each year. And obviously, kind of going back to our quote that we started with, these are the best teams in the playoffs, or the best teams in the NFL, right? Now that means that 18 teams go home and they watch the playoffs from home. Again, the question here is, if you looked at all the teams, all 32 teams in the NFL, and this was what the stock market was, is 32 teams that you could invest your money in, which teams would you want to invest your money in? Would you want to put all your money on one team and hope that they end up winning the Super Bowl at the beginning of the season? Probably not. Would you want to invest your team in maybe 3 or 4 of your favorite teams? I don't know if that's a good idea either, because I just got done saying my favorite team my whole life's been the Cleveland Browns, and that probably would not have been a good investment. So maybe it makes more sense to invest our money, metaphorically speaking, in the playoff teams from last year. So in other words, whatever the top 14 teams, or if you want to drill down further and say, I'm just going to invest in the top teams without any regard to the wild card teams, and now I'm getting too nerdy into sports, that is, but if all we do is just invest in the playoff teams and avoid the rest, I think that our retirement portfolio, would be in pretty good shape. So, if we go through here and say college football, it works with college football too. It works with, as I said in the intro, there's 130 teams in the NCAA, and only 4 of those teams make the college football playoffs. Obviously, our Buckeyes, for those of you who are listening in or watching in Columbus, Ohio, Buckeye fans, we're still suffering a kind of a loss hangover, if you will, from the Alabama victory just a few nights ago. But maybe you wouldn't want to invest all your money in 4 teams out of 130, because that would be pretty concentrated. But what if we use the top 25 teams in our metaphorical portfolio? The top 25 teams would be from last year, or the top 25 teams as we go through the year. Probably wouldn't be a horrible idea. But you can pick any analogy you want. Like I said earlier, NHL hockey, Major League Baseball, March Madness, the CrossFit Games, whatever your thing is, whatever you enjoy watching that's competitive in life. I think the analogy works in any of these situations, in that if money could not be invested in the stock market, in the bond market, in the commodities market, if there were no stocks, and we had to invest our money in these other things, I think the way we would probably do it if we wanted to be successful is we would invest in the teams that are exhibiting the strongest relative strength versus the other teams. So the highest RS is short for relative strength, the strongest teams, and maybe avoiding the weakest teams. So some tricks to the trade here, some statistics. Most of the teams that make the playoffs last year, I would say a good chunk of them tend to make the playoffs the following year as well. And the same can be said for investments. So the statistics go like this, and you could use 3 months, 6 months, 12 months, but the way I was taught by Charles Kirkpatrick II, Charlie Kirkpatrick, Charlie taught me that the investments that tend to exhibit the highest strength over the past 26 weeks, or in other words 6 months, tend to continue to be strong over the next 6 months. He also said that the best investments over the last 2 to 3 years tend to be some of the underperformers over the following 2 to 3 years. So, but you can look at, this has been done in many different ways. There's been several studies on relative strength. I use different screens that involve 12 months down to 3 months, where I weight certain months heavier than others. But the point is that the investments, just like the teams in the NFL or the teams in any sport that tend to be strongest as of late, tend to continue to be strong until they're not. We could use the New England Patriots as an example, because they've been so good for so long. And then Tom Brady leaves and goes down to Tampa Bay, and all of a sudden, the Patriots are missing the playoffs for the first time in a really long time. Now, conversely, it's important to understand that the weakest investments tend to stay weak. So just like the stronger investments tend to stay strong, or strength begets strength, weakness has a tendency to beget weakness, and things that are weak tend to stay weak for quite a while until they can change the trend. So I think we could probably say the same, not to keep going back to my Browns. Obviously, I'm a little excited here, but I think we could say the same for the Cleveland Browns, in that they've been really, really weak for a really long time. And how many times, if you know a Browns fan, or you are one, did you say, "Oh, we've got next year, and it'll turn around next year"? And so it takes time. It takes time to see that momentum shift, and whether that's sports or investing. I do have a couple visuals here for those of you that want to pull these up. They're not necessary to look at. I'm just going to talk you through them here. But when you look at some of the longest consecutive playoff appearances of all time in the NFL, for those of you who are football fans, you're probably going to remember some of these. But the Patriots made the playoffs 11 years in a row. So basically from 2009 through this past year, 2019, or I guess that's 2 years ago now, they made the playoffs every single year. And even before that, they only missed the playoffs, I believe it was 3 years during the 2000s, and appeared in several Super Bowls and won, obviously, a good handful of them. The Packers made the playoffs 8 years in a row. The Seahawks made the playoffs 5 years in a row, but they haven't been back in a few years. The Chiefs, as of recent, have made the playoffs now 6 years in a row. You look at the Colts back in the 2000s. You got Peyton Manning and the Colts and Tony Dungy. The Indianapolis Colts made the playoffs 9 years in a row. The Miami Dolphins between 1997 and 2001 made the playoffs 5 years in a row. If we go back further into the 90s, 80s, 70s, again, we've got the Chiefs that had made the playoffs 6 years in a row. If you remember, the Houston Oilers made the playoffs 7 years in a row. The Buffalo Bills, even though I was never a fan, the Buffalo Bills made the playoffs 6 years in a row. They went to the Super Bowl 4 times and lost all 4 times, which is probably rough. But again, there's nothing wrong with being the second place team in your portfolio as long as you own that second place team. You don't have to pick the winner every year. You have to stay invested in the playoff teams, and that's what we're talking about here. So the Cowboys between the 70s and the 80s went to the playoffs 9 years in a row. The Steelers and the Rams both went to the playoffs 8 years in a row. And we have to go all the way back to the 40s and the 50s when the Cleveland Browns went to the playoffs 10 years in a row. But that's how long it took before we started to see a trend change in terms of consecutive playoff appearances for the Browns. And a kind of a fun note here, while the Browns, they made the playoffs 10 years in a row back in the 40s and 50s, they also own, as many of you probably already know, the top losing streak in history, which between a 3-year period in the 2010s, they won only 4 games out of 48 total games played in 3 years, which is incredibly horrible. So when we translate this into investing, what I want to talk to you about just briefly here, and specifically when we're looking at today's market, is the different investments going on right now, and those investments that are exhibiting that high relative strength. Like, and I've got things like at the top of my list are solar. And solar investments, solar stocks, have been exhibiting some of the highest strength, or we'll call it playoff appearances, if you will, since pretty much the third quarter, call it late third quarter of 2020, and continue to be the number one performer since then. So even though we were probably, 2-3 months away from the presidential election, and solar stocks tend to be investments that perhaps might perform better during a Biden administration as opposed to Trump winning re-election. We all know now that Trump lost the election, that Biden won, but solar stocks started outperforming and started exhibiting that relative strength, that high RS leadership back in late third quarter, early fourth quarter. This was before the election. Similarly speaking, we've got lithium stocks, so battery stocks, things that, companies that make things for electric vehicles. We've got blockchain, genomics, robotics, steel. When you think steel, what in the world? Why in the world would steel be exhibiting strength? Well, because when you have a Democratic president, perhaps we're going to see some more infrastructure investment. Maybe taxes will go up. Don't know. I think it's probably likely. But maybe we'll start to see more investment in infrastructure, bridges, buildings, and things of that nature. Technology, IPOs, online retail, automotive stocks, including, of course, hybrid and electric vehicles, metals and mining. And then most recently, we've started to see things like regional banks, big banks, as well as energy stocks. For the first time in a really long time, energy has started to come around when it's really been in the basement. It's been one of the weaker, call it Cleveland Browns type stocks for a really long time. So I guess we might be able to call I'm just thinking of this now, but we might be able to call energy the Cleveland Browns of investing. But I'm sure that somebody listening who knows anything about investing would probably tell me that even energy has performed a lot better than the Browns for the past couple of decades. So speaking of, I just want to kind of go over some final thoughts. You never, ever, speaking of favorite teams, you never want to root for your favorite team in investing. If you get married to any investment, whether that's an individual stock that you like, whether that's a sector you like, whether that's, a certain asset class like international stocks versus commodities versus currencies versus U.S. stocks, you never want to get married to anything because things can change. And it becomes extremely difficult to sell something. Things like that come to mind are things like Bitcoin and Tesla. People get married to these investments because they like them. And I think one of my earliest mentors said, as soon as you like something, you think something's going to happen, you hope it's going to happen, you've already lost in investing because you have this marriage to the investment, and you're hoping it's going to go up, or you're going to find excuses or look for research that's going to support your opinion because you like it. You shouldn't like any stock. You shouldn't like any investment. It should just, if it's going up and if it's exhibiting strength and if it's continuing to give you growth in your portfolio, then it should be something you continue to own. And if it's not, then you should eject it and find something else that's performing, that's showing, again, exhibiting that relative strength. And that goes right along with being open-minded. You have to stay open-minded. By nature, asset classes, like I said, U.S. stocks, international stocks, commodities, currencies, all these things are rotational in nature. They, over time, Julius de Campanaere, I didn't want to throw in a relative strength, a relative rotation graph today, but Julius de Campanaere, back in 2011, so 9 years ago at this point, invented the relative rotation graph, which proves that asset classes, industry groups, and sectors rotate over time. And so you have to stay open-minded, because as these asset classes, sectors, and industry groups rotate, you want to be open-minded to see what maybe the new best performer might be. You want to stay open-minded, so if something that maybe didn't perform for you in the past is going to come around now, because you don't want to be so closed-minded that you say, I'm not buying that thing because I had a bad experience with it in the past. So being open-minded is extremely crucial in investing and building a winning investment strategy. And then last, you got to focus on what matters the most and ignore all the rest. So creating a system or having a system that you can stick to. If you don't have one, working with a financial advisory firm, a portfolio manager, financial planning firm that has a system that makes sense, that aligns with your goals, with how you feel comfortable with investing, not only from the standpoint of strategy, but from a risk standpoint, and something that you can stick to long term. And then avoiding the news headlines, because there is no shortage of headlines that are going to come up that are going to try to help force you to abandon your investment strategy. Like right now, there's really nothing going on in the news right now, is there? So we have people storming the Capitol building. We have a president that's being impeached again. The stock market's going up, and you can't deny that. And you have to stay focused on really what matters. And things for me, what matters most when I'm managing portfolios is the price, the trend, the momentum of price, and volume. In other words, I want to see when the market's going up, I want to see a high volume day. That means that there's a lot of people, institutions participating when the market's going up. And then when we see the market go down on a day or a week or a month, I want to see low volume days, weeks, and months, because what that tells me is when the things are going down, that it's not really being supported by a lot of participation. So what we want to see is big up days, small down days, and inevitably I can't control any of this. So when we start to see big down days and small up days, when we start start to see momentum shift, when we start to see trends change, that's when we need to shift how we have our portfolio invested, not only by makeup. In other words, maybe we want to own blue chips, high dividend payers, utilities and real estate, as opposed to, say, in a booming market, technology, online retail, and biotech, for instance. So to avoid going on a huge tangent here, which I know I will, I'll go ahead and finish off to today. I'll say, so that's going to be it for today's show. I'll try to piggyback on this maybe in the next week or two in one of the following podcasts. But please feel free to share this episode with your friends and family. And if you'd like to discuss your personal situation further, if you'd like to have a second opinion on your investment portfolio or your investment strategy, or if you'd like to learn more about ours and how we do what we do, please reach out. You can set up an introduction call with my office. You can set up a Zoom meeting. You can help, and you can do so just by heading over to our website to schedule something on our calendar. There's actually a link at libertaswealth.com on our contact page where you can get access to our calendar. And as always, there's thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Please be sure to subscribe both on iTunes and YouTube. And remember, you can sign up at libertaswealth.com to get these updates, as well as other screencasts that we record, videos, articles, all of these things delivered directly to your email inbox. Please feel free to follow us on Facebook at facebook.com/LibertasWealth. Again, I'm also on Twitter at Adam Koós, as well as Instagram at Financial Surgeon. So thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koós. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.